If you're looking to raise capital for energy investments, launching an offshore oil and gas fund can be a powerful structure. Offshore funds allow managers to pool international capital and invest it directly in drilling projects or energy companies and operate with a tax-efficient structure designed for global investors. In this video, I'm going to walk you through the key steps to launching an offshore oil and gas fund. Hey, it's Frank Nagy. Welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. The first step is selecting the jurisdiction where your fund will be domiciled. If it's in the US, I recommend Delaware for US investors. Popular offshore financial centers include the British Virgin Islands. Many energy-focused funds choose offshore jurisdictions because they provide regulatory clarity, investor familiarity, and tax neutrality for international investors. Typically, the fund will be structured as an exempted limited corporation or an investment company with a management entity responsible for investment decisions. This structure separates investors from the manager while providing flexibility in how profits are distributed. Most offshore oil and gas funds use two entity structures: the fund vehicle, where the investor's money is placed, and the investment manager, the firm that's responsible for sourcing and managing the energy investments. The fund vehicle pools capital from investors like high net worth individuals, family offices, energy industry investors, institutional allocators, and pension funds. The investment manager then deploys that capital into oil and gas opportunities such as drilling programs, working interests in wells, energy royalties, oil and gas operating companies, or a midstream infrastructure. Many managers also create special purpose vehicles for individual deals to isolate the risk for each partnership. Hiring an experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or oil and gas fund. A good consultant will make the appropriate introductions with fund administrators, auditors, attorneys, banks, and other oil and gas opportunities that can help your hedge fund or oil and gas deal grow. Offshore funds commonly rely on exemptions designed for professional or sophisticated investors. This means the fund typically markets only to qualified investors who meet minimum investment thresholds based on the jurisdiction that it's registered in. The fund administrator and legal counsel and consultant will help ensure the offering documents comply with local regulations and opportunities for your fund. The key service providers usually include an offshore legal counsel, the fund administrator, an auditor, compliance officer, banking and custody providers, and of course your consultant. Having credible service providers significantly improves investor confidence. To raise capital, you'll need professional private placement memorandum or a PPM, and this document explains the investment entity, the investment strategy, oil and gas deal, pipelines, risk disclosures, fee structure, and a management experience. Most oil and gas funds charge a management fee and a performance fee. This usually looks like a 2% management fee on assets under management and a 20% performance fee on any profits earned. The PPM also outlines how capital is deployed, how distributions are paid, and the expected investment horizon, which for energy projects can range from 3 to 10 years. One of the most important factors in oil and gas fund is deal flow. Managers typically partner with exploration and production companies, energy operators, geological consultants, and mineral rights owners. Investments can include development drilling, proven producing wells, royalty interests, and distressed energy assets. Experienced fund managers can focus on lower risk producing assets that generate cash flow while maintaining upside from new drilling opportunities. Capital raising for energy funds usually comes from investors seeking real asset exposure and commodity diversification. Common source of capital includes family offices, commonly focused investors, energy executives, and private wealth investors. Many investors and managers start with $1 million and they can go up to $50 million depending on the opportunity. Clear communication and transparent reporting and strong deal sourcing are key to grow the fund over time. Launching an offshore oil and gas fund requires the right structure, experienced service providers, and a strong pipeline of energy investments, no pun intended. But when structured correctly, these funds can attract global capital while providing investors exposure to one of the world's most important industries. Hey, if you'd like to learn more about Frank Nagy Financial Services and how we can help you set up and structure your hedge fund or oil and gas opportunity fund, which we have enormous amount of contacts in that arena, contact the links below in the description box.